Hello everybody, it's time for FLCT's full year 23 results. I think in conclusion, the numbers were some good, some bad, but the share price is just very cheap. It's been of a crazy year, right? I sold all my FLCT, which was like 7% of my portfolio at 1.35 earlier this year. So I made a video about it where I talk about the selling of the REITs in the STI index around mid of this year. So everything was just overpriced with the fundamentals and the rising interest rates. And now in September, I bought back everything at 1.07. I think I went all the way down to 1.04. That's a big lesson that I learned from last year. First, last year I was too much in a hurry and just spent all my bullets in September and October. So this year I spread out my capital and gonna spread it out from September to December. So just slowly accumulating everything back. To me, well, this was the least risky move to take because I sold everything and it's just buying everything back that I sold at a lower price, right? And I think fundamentally this stuff is still a very blue chip name, very well capitalized balance sheet with quality assets. It's crazy, right? Look at it from a 1 year perspective. Started a year at 1.1, went to 1.35, dropped another 35% to a 1.0, and now back to 1.1, or a bit of a relief rally post FOMC, where people are a bit dissing Powell's hawkish comments and thinking that the Fed is done the hiking rates. Well, I don't know what they will do, but I think something interesting was this document that this article that I read on Zero Hedge, saying that with the rise in interest rates in the US, the annual interest payment for the US is going to be 1.7 trillion. That's equivalent to the Australian GDP every year. I think this is crazy, right? The amount of money they pay to service the debt is equivalent to the entire Australia's GDP. I think even after the inflation story is over and people are happy with the interest rate, anticipating a rate cut, I think back on the yield curve, back end of the 10-year treasuries is still going to be very elevated as people start thinking about the next big story, which is the rising the developed world's government's debt and the interest payments that they need to pay, and how it's going to pan out. Are the politicians disciplined enough to rein in spending, cut entitlements, or are they going to compel the central banks who become their slaves in buying back the debts in an outright manifestation of helicopter money and MMT? I don't know what's going to happen though, but I think this is going to dominate the headlines in the next 2 or 3 years once the inflation story dies down. So I don't know, man. You have to think about it and what it means in terms of the yield products and the interest rates. Well, back to fundamentals and the FLCT's numbers. I think in general the DPU was quite in line with what I expected. 7 cents for the full year, which was pretty much what I talked about 6 months ago. If you look at the full year DI of $262 million, $25 million of it was capital top-ups, of which 16 million was the capital from divestment gains, meaning the sale from cross street and stuff. So 16 million translates to 0.3 cents of DPU. So if you take away this stuff from this stuff, the operational DPU was 6.7 cents. So decent drop from last year, but you expect it, right, because of the income void from the selling of cross street, as well as FX headwinds, with the mighty Sing dollar still having creating havoc for all income source from overseas. So I think in general the results are quite in line. But if you look at this current DPU, which I think is quite easily sustainable actually, it translates to a 6.5% dividend yield. I think this is a way too sufficient, very sufficient for this blue chip name with solid assets actually. Major thing that I think the market was focusing on was the valuations because of the rise in cap rates in the EU, UK, and Australia. And you see that in general the NAV dropped from 1.3 to 1.7 because of the drop in the asset valuations, and this had the effect on the gearing, which went from 28 to 30. And but I think in general it's still very low, right? 30% is nothing much compared to some of the other stuff that you see, and the assets are still very good quality though. So you look at the valuations, Singapore properties are still quite stable. In fact, it's small up. The big thing was the valuation losses in the UK, down 20%. It's a bit nuts. But I think this is all expected. I think in general this stuff is expected, maybe a bit worse than expectations. But the fall in valuations for Australia and the EU is actually quite in line. I expect everything to be down by 8 to 12%. So I think it's quite in line. I think the major thing to look out for is the debt resurfacing for the next 3 years, because you see everything is quite lumped together for over the next 3 years, right? Some of the other REITs have a better profile of everything at the back, so this guy has a bunch of refinancing to carry on for the next 3 years. But I think in general, after I've done some analysis, which I'll talk about subsequently, I think it's quite okay actually. So I'll show you what I'll do to calculate the impact and whether I'm comfortable with the risk subsequently. Something I'm quite happy about is acquisition of some stuff in Netherlands. So I'm quite happy, right? Because I bought this stuff at 1.04, 1.05, 1.06, right? So that's like a 0.9 of book. And then they managed to buy this property at the 12% discount to valuations. So I buy the REIT at 0.9 book and they buy the property at 0.87 book. So I'm actually getting very, very cheap stuff because of the stuff. So I like this stuff which is happening where people REITs with a good balance sheet, low gear, take advantage of this current market volatility to buy distressed assets well located with good properties, right? Good asset value, asset properties, right? So you look at this stuff, it's freehold, you have a CPI indexation. I think if you work out the math, this acquisition is probably going to be at the cap rate of around 6%. They didn't really mention it, but if I do the calculations, it seems to be that way. And they said that it's DPU accretive. So, well, even if you ignore the assumptions and calculations, it's still DPU accretive of freehold property near the airport. So, I think it's a good thing though. I like what's happening. You look at the leasing and the reversions, it's still very impressive. Overall portfolio valuation reversions is still very, very positive. The logistics and industrial arm is still very, very strong. And this number is actually quite consistent with what you see from other logistics REITs, be it the ESR REIT or AIMS, which reported a magnificent set of results on Friday actually. If you look at the average to average reversion is 33%. Even incoming versus outgoing is up 20%, right? Because normally what happens in Australia is that you have starting rents this over here, and then it goes up, and then it goes up, and then it goes up because of indexation. And then when it's time to renew, most often it just drops, right? But this time round is different. It didn't drop, it goes up. So this is quite rare to see. Very often, if you look at FLCT's Australian properties, this number is positive, but this number can be negative because when they renew the lease, the incoming versus outgoing is negative. So in this case, you can see that the reversion is actually very, very positive. The commercial assets is still continuing to be a bit of a weakness. You see a negative reversions here. And in Singapore, although you have 8% over here, I think 2024 will be quite interesting because ATP, Alexandria Technopark, will be up for renewal for Google's leases. And I think Google is not going to renew. So that's going to happen in February 24 and I think December 24 as well. So I think it's going to be a bit of a market concern to see what's gonna happen for the ATP leases and whether they'll be able to backfill everything. But this thing has happened before at the previous Fraser's Logistics and Fraser's Commercial Trust, right? Where the ATP was vacated and they managed to find a replacement. So I think this stuff is still quite okay, and I think valuations are probably gonna be quite well supported. But one thing though is the lease in September 25 with Commonwealth of Australia. So again, this is a commercial property, and this stuff is going to be a concern in 2025. So I think the logistics and industrial arm for this guy is still performing very well, but the commercial side continues to be a bit of a concern with headwinds post COVID. It's going to be a drag on the earnings, I think. So finally, let's just go through the impact of them refinancing the debt. And I reproduce the numbers over here. DI this year was 262 million, DPU was 7 cents, and this is the main concern, right? Around 522 million every year for the next 3 years. So what's the impact? So let's assume that when they refi this stuff, everything goes up by 4%. I think this is an exaggeration now because if you look at the interest rates in the UK, in the Australia, actually they are not up 4% from where they refi. But let's just assume the worst case and just prepare ourselves for what's going to happen. So 520 million times 4% jump in interest rates, right? It's $21 million of additional interest costs, and this is somewhat like the worst case, right? So current DI is 262. And if you assume this plot to refi at the 4% jump, so that's going to be 241 million left. So that's 6% dividend yield of current share prices. And going to 25, you assume that everything is going to be refined at 4% higher as well. So that's going to translate to a 5.45% dividend yield. And if you go to 26 and you assume that the interest rates are going to stay high there as well, and they need to refine everything again at 4% interest rate higher, that's going to translate to a 5% dividend yield. Do you think this compensation is good enough for you? For me, I think it's okay, because if they really do have to refi this stuff and this stuff and this stuff at 4% higher for the next 3 years, in FY26, I'm still gonna get 5% dividend yield, which I think is very, very good compensation for the risk involved. Furthermore, I do not think that interest rate is gonna stay at 4% higher for the next 3 years. I think FY24 is still gonna see elevated interest rates, but in FY25 we're gonna see a substantial cut, and 26 is just gonna go back to normal. Maybe it's somewhat elevated because of the somewhat elevated inflation post-COVID. But nonetheless, risks are not going to stay at 4% higher for the next 3 to 4 years. So even if you do the worst case analysis, my conclusion is that this stuff is still very, very good. The compensation for the risk involved. That's why I'm after calculating everything, I just spent a whole bunch of capital to buy back everything that I sold at 1.35 earlier. So do this calculation yourself and see if it fits your risk profile. And if you do, well, just fire your capital away.